Most people don't lose money in crypto because Bitcoin crashes. They lose money because they ignore the signals that warn them first. In this video, I will walk you through 5 Bitcoin indicators that have preceded every major move, bull runs and crashes. I am not here to tell you if Bitcoin will go up or down in 2026. I will show you the data, the tools and let you decide what to do next. Stick until the end of this video because the fifth indicator on our list is the one most retail investors completely ignore. Indicator number 1 on our list is going to be Bitcoin dominance. Bitcoin dominance simply measures how much of the total crypto value is stored in Bitcoin. Currently, this percentage is close to 59.8% right now. At a very first glance, this looks very simple. But if you look a bit deeper into this, you will get to know exactly where capital is flowing. Bitcoin dominance reveals that a rising dominance usually means investors are moving into Bitcoin for safety. And a falling dominance, as you can see on this chart right here, usually means that risk appetite is increasing and capital is now moving into altcoins. Historically speaking, some of the biggest market transitions happened when dominance stopped trending and it reversed. When Bitcoin dominance rises very sharply, it often means the market is becoming defensive. And when it falls aggressively, it can signal that speculation is heating up in the market. Now, this indicator does not specifically tell you where Bitcoin's price is going to be tomorrow or day after tomorrow or a month from now, but this helps you understand what kind of market you are exactly in. The second indicator on our list answers a very crucial and important question, which is Bitcoin cheap or expensive relative to its own history? The MVRV indicator compares Bitcoin's market value to its realized value, basically the average price which coins last moved. Now, I don't want you to get scared by this name MVRVZ. All you need to understand through the MVRVZ score is this: a very high MVRV ratio or zones have appeared almost near the cycle tops. Very low or negative zones have appeared near long-term bottoms. Now, this does not mean that Bitcoin instantly crashes when the MVRV is high. What it means is risk increases as price moves further away from its historical cost basis. I personally like to think of the MVRV ratio as like a temperature gauge for the market. It doesn't tell you exactly whether the market is broken or not, but what it does tell you is that whether market is overheating or not. But this single indicator is not enough because Bitcoin alone can stay overheated longer than anyone expects. And to understand the holder behavior, I'm going to show you the number 3 tool on our list, which is going to be hodl waves. This is a very powerful on-chain indicator that gives insights into the market psychology itself. The hodl wave shows how long Bitcoin has been held without moving or without selling, of course. But why does this even matter right now? Older coins moving equals long-term holders distributing, and younger coins dominating equals speculative activity is on the rise. Historically, major cycle tops were marked by a decline in very old coin bands and a rapid increase in recently moved coins. This is exactly what the Bitcoin hodl waves chart shows you. On the left, you would be able to see a chart that is color coded and indicates how long the tokens or Bitcoins have been held. And on the chart, you would be able to see that basically some long-term holders have dumped or sold or moved their BTC when it was above $100,000. And I want to give a strong emphasis on some. Majority of OG BTC holders are still holding their BTC strong. This indicator gives me an idea on who controls the supply at different phases of the cycle. When older holders stay inactive, it often signals confidence, but when they start moving their coins consistently, it signals distribution. But all of this data isn't useful in isolation. That's why we need to take a look at macroeconomics. Indicator number 4 on our list is going to be related to liquidity and interest rates. Bitcoin is often treated like it's something that is outside of the traditional finance system. But in reality, with Bitcoin's ETF, Bitcoin is now deeply affected by global liquidity. Liquidity refers to how easy it is for money to move through the system. Expanding liquidity supports risk assets like Bitcoin. A tightening liquidity would take money away from riskier assets like Bitcoin and other crypto assets. Historically speaking, Bitcoin has struggled when interest rates rise rapidly and something like the dollar strengthens aggressively. By the way, all of these tools, charts that I have mentioned in this video will be linked below in the description, so feel free to check those out. An important point here that you need to remember is that Bitcoin doesn't usually top before liquidity tightens. It often tops after liquidity peaks. So you need to track the global liquidity in order to gauge what Bitcoin is going to do next. Understanding global liquidity helps you understand whether the broader environment is supportive or restrictive of Bitcoin and other crypto assets. Staring at price charts alone is not going to give you indications of what the price is going to do tomorrow. And finally, we get to the indicator that often decides how violent the next BTC move will be. This is the indicator that most people ignore, and it's often the most dangerous one. Markets don't crash because of bad news alone. They crash when positioning becomes very fragile. So the indicator number 5 on our list is going to be understanding market sentiment and leverage. What sentiment and leverage shows is how aggressively traders are positioned and whether a move could trigger forced liquidations. To check these two things, I primarily take a look at the fear and greed index. You would be surprised to see how accurate this tool has been in the crypto market. And the second thing that you need to understand is the funding rate as well as open interest. And to check funding rates, I usually use CoinGlass. Of course, linked will be in the description below. A high funding rate usually means that traders are paying to stay in their positions, and high open interest means leverages are stacked. This does not guarantee a crash, but it increases instability. Almost every major liquidation cascade in Bitcoin history happened when leveraged was stretched too much and the sentiment was one-sided. And there is one more indicator that you are missing out on, and the indicator is going to be subscribing to this channel and liking this video if you learned something new or you have enjoyed the video so far. Now, no single indicator is going to decide Bitcoin's future, but when Bitcoin dominance starts shifting, valuation stretches relative to history, long-term held coins start to move, and liquidity condition tightens, that's when ignoring these signals become very expensive for an investor. I am not telling you to buy anything. I am not telling you to sell anything. I am saying that if you are in crypto, you owe it to yourself to watch these signals instead of guessing and staring charts 12 hours a day. And that's all for this video. If you want to understand crypto market crashes, then I recommend you to watch this video right here.